Um, so the market's going up a few points, and you find a lot of aggressive buyers, and the earlier in the move, the better. They have more opportunity to drive the market. But eventually, David, they're going to run into a bunch of sellers, and I'm sorry, a bunch of market makers that. Market makers are now, because it's gone up several points, for whatever reason they decide it's gone up enough. In this case, it's 2 standard deviations away from the mean. Maybe that's one of the reasons. They're going to try, and they're already long. They have an enormous amount of limit sells in, so the aggressive buyers could be one of 2 things. They're aggressive buyers who are coming in late and who wind up getting stuck because they think the market's breaking out and it's going to go higher, which was in my case on last Friday, and the market doesn't go anywhere and turns around and goes down. Or the market's finding buy stop orders. Those buy stop orders are going to be filled on the right hand side as aggressive buyers, and so they're finding a bunch of buy stop orders. However, the market makers already have the huge passive orders in there, and that could be for 2 reasons, David. One, that they've gotten long down here, or 3 reasons really. So they're getting out of longs, they're putting on shorts because they believe, statistically that's the end of it, or 3, they're just hedging another position. And so those are some of the reasons why those buyers would get stuffed up in that area. And after it's already made a move, let me say this first. If the bars are blue and the market is starting, in this case, to turn, and the hull is starting to turn up, and you've got a lot of dark green, and it's right at or under these prior highs over here. Now my pointer's up on the 610 chart in the upper left. You'd want to see the market get through that old high, of course, pretty quickly. Because if it doesn't, then they're of course getting stuffed at an old high. But after it's already gone through that high, and this is one of the things you want to keep in mind with context, is the higher it goes, is it slowing down? Take a look at the time. Is it one of those things where no matter how many aggressive sellers do come in, it doesn't drop but a couple of ticks? Then the market makers are really active, and they're chasing, in that case, the market higher. And so those sellers, as the market's going up and the sellers are slamming the bid, and there's bright red every other bar, or maybe 2 in 1 bar, and yet it doesn't drop, those are really people who are just they're taking profits. But market makers are saying, no, that's fine, you sell them all to me, I'm going to keep buying them because I think it's going up. My algorithm, maybe my portfolio manager, or maybe whatever, is saying we got to buy like crazy, and as it goes up they keep putting in thousands and thousands at each tick that it goes higher. And so those bright reds can get stuffed like the Thanksgiving turkey I talk about, even not even when it's going up, but at a time when the market's rising, and not necessarily when it goes down 6, 7, 8 points and they find a level of support. So yeah, it can happen even when it's going up. But those would be some of the different situations. Yeah, and I thought that was going to happen, and well, it did, and that was pretty amazing. You're right, Dave. It was. What was interesting really is what happened then later on, the second half of that day. If I know it's off the screen here, or yeah, you guys can see it. Go over to the 30-minute chart. I think it was this day. I know this part isn't being recorded, but it was this day where the market was coming down from 1445, and those market makers were buying every tick. Even when it ticked up a couple, they kept putting in thousands of buy orders, but the aggressive sellers just wouldn't stop. And so it was this first half of the day where market makers are just annihilated. And then the second half of the day, it was very, very light size on the bottom. However, we ran out of the aggressive sellers. It did go lower, but when you see very small amounts of market makers, the ES will tend to make some pretty big moves. And although again it did go lower, nosedive. And maybe the context of that is that it had already dropped from 1450 to 1430 and a half, 20 points. And again, it did go lower, but it was already down 20 points, and so to think it would go another 20 or 30 is sort of a super rare situation and shouldn't be expected. What kind of stops do market makers generally use, Randy asks. They don't. They just don't. And so what they're doing is and the market makers these days, by the way, Randy, are huge companies. The guys who are down on the floor, yes, they're still market makers down there on the floor, but they're chasing the S&P now. They're not the type of market makers that I'm thinking of. And somebody mentioned once in the classroom here, maybe a year, maybe longer ago, that I heard there's no market makers in the S&P, in the mini S&P, because it's electronic. Well, I think what he was told by a friend or colleague or whoever is that there's no people that are market makers, and that's true, but it's now in a different form, and that would be the huge orders that are coming in from the banks and from the hedge funds and some pension funds and that sort of thing that are indeed making the market with all of the limit orders on the order book, with the whale programs and that I named, and just some of the basic algorithms. By the way, most of the HFT, guys, is market making algorithms. It's not the turn on it's not just when we say that the Skynet has been turned to buy them all. That is an offshoot of the high frequency trading algorithms. But the majority of the time, it's just market-making algos that are putting huge orders in to buy, say, evens and sell quarters. Buy evens and sell halves if it gets up there. Sell the halves, buy the quarters. Exactly what the guys did on the floor when there was no electronic trading. And that's what keeps the market in line until maybe some surprise news announcement comes out, and then you'll hear me say, oh my God, the order book just got really thin. That's because something came out, or maybe you'll notice that before the Fed numbers come out. It'll go from 3,000 that you can see, because there's icebergs, but 3,000 orders on the bid and up at the offer at every tick that you can see until it gets to a couple of minutes before the Fed or any other number, and then it evaporates to only a few hundred. That's because they don't know what's going to happen, and they're not going to put all that money out there to get steamrolled on a massive move that could wipe them out. So, but let me finish up with this. I said the market makers don't use stops, and that's because they have these programs that are faster. They're literally bordering on the speed of light. That's how fast they are able to get their orders in and out. And they also have an enormous sum of money, so that, let's take an example like this. Just anything here. So let's say they're buying let's say they're buying here 1409 and they're selling a quarter. They bought 9, sold quarters. Maybe their particular algorithm then would rather buy 9.5 and sell 75s. I don't know. There's millions of different types. Maybe when they do that, when they buy 9s and sell quarters, they're not going to buy 75. They're going to wait till it goes to a half. Buy half and sell 8.75s. Oh, it didn't do that. It dropped down to 8.25. So they buy quarters and sell halves. So they got out of that trade, but they're still wearing one. Then it drops down again. They buy evens and they sell quarters, but I'm still wearing one. And so what they're doing is, as they're buying and selling and buying and selling, they're getting out of a lot of them, but they might be stuck holding one or two. So they're starting to build an inventory now. And as they build an inventory, then there's an exit point where, and I'm just going to make a number up, but let's say they're in and out and in and out and in and out as the market is rotating back and forth or auctioning back and forth. And as they, in the example I just showed you where they may not get filled on one of their exits, they'll hold it. And the program keeps going and then they might be stuck with a couple more, but let's say their limit is 100, just to use a round number. Well, when they get to a limit like that, then they just sell those out at the market and they're done. That's exactly what happened, by the way. I mentioned the flash crash before. It's exactly what happened during the flash crash. As the market was going down, those market maker programs were they couldn't sell at the higher tick all the time. In fact, couldn't, not hardly at all. And so as it's going up and down and up and down, and then all of a sudden it's mostly going down, they kept adding more and more and more and more to their inventory, and they reached the uncle part where, you know, Patrick put a chokehold on them and they tapping out, and they literally all dumped at the same time, and the market went straight down in that wicked crash because they all had to get out at the same time. They reached their breaking point and they all got out, and after that most of them just turned their programs off. So again, they don't use trailing stops, so they're adding to their inventory, and if they reach the uncle point, they'll get out. But I wanted to mention that again because what they normally find is that in this case, going back to the tape, that the market will make its eventual move up a couple, 3, 4, 5 ticks. In this case, it's several points. Well, they're going to wind up getting out of that inventory, maybe not at a huge profit, but at a small gain, because as they're on the left-hand side here, remember their first few buys that they may have been stuck with is at a higher point. Yes, they're averaging in lower, but as the market goes up, they might say, okay, now I'm just going to exit my last portion at a 1 or 2 tick gain just to be profitable. I'm not going to look for a killing. Again, this is all programmed into their logic of the algorithm, but that's what they do. That's my understanding of what they do, and I'm pretty sure I'm right. So they'll build that inventory, and when it eventually goes up, they'll make their money, something that most people can't do. And if they get to a breaking point, they cry uncle, and it's not a stop, it's just a market order to get me out, and then they get hammered on that. Yeah, that, Stuart, is the definition that most people have for that. And 1, maybe 2 ticks. I don't think they're usually trying to make more than that. Now there's other algorithms, Stuart, that are looking for more than that, but those are not those aren't really market makers. They are, if I can find one, like right here. These aren't market makers driving the ES higher from 1400 up to 06.5. This is an aggressive algorithm that's driving it higher. And these guys might be looking for 2 or 3 ticks, maybe even a point. But when they're doing that, they're constantly buying even as it goes higher. They're not going to buy 100 and say, okay, let's sit back and see how high it goes, like the average retail trader does, because they have these programs that are as fast or almost as fast as the speed of light, as close as you can get in a machine anyways. They are buying and buying more and buying more and buying more, and driving the market higher very aggressively and looking for more than a tick. And so that's a different type of high frequency algorithm. I always had stops in, Randy. I wasn't like that. I was never in the pit either. I never traded in the pit. I was on the floor, but I was in a booth in between the S&P, the NASDAQ, and the mini Dow. Never in any of those pits. Okay, Perry wants me to explain failed auction again. A failed auction, we can use right where we're at here. We have a few of them on the way up. This is my definition of a failed auction. This is not necessarily everyone else's definition of it, but I think it's an excellent one. Remember when earlier when I was talking about the bid and the ask? Perry? So there's a bid, and it is, say, 1402, and an offer at 1402 and a quarter. Let me see if I can use a drawing tool for something here. Alright, that's not... Well, let me do it up here. Maybe I can get it. Here we go. So I'm just going to make some crazy squiggly lines up here to show you that the bid and the offer is always at a different price. It's never at the same price. So you can only sell the bid right here or buy the offer up here. They're never at the same price. Now we see these numbers that are at the exact same price. My pointer's now down in the volume chart. That are at the same price, and people often think, and this is where another way that this chart can be confusing, is that they look at that and they see, well, there were buyers and sellers at the exact same price, and then they also think it probably happened at the same time. That's not how it works. You can only sell the bid, which is lower, and buy the offer, which is higher. And trust me, you will see it if you're looking at your dome. I'll pull that into this viewing screen here. So it's when the market did close this morning, or actually never opened, so in the pre-market it closed, it looks like it was 2.5 was the bid and 0275 was the offer. So it's not at the same price. There's always two different prices where you trade at. And when we go back to this over here, 1 second, we're going to use this example, right? 1403.50. So if you're looking at this when it's trading in real time, you're going to see that the bid drops down to 325. You're not going to see it on this volume chart. I want to be very clear here. You will not see that happen on the volume chart, but you will see it happen on your dome. So you'll see it drop down to 3.25 in this example here, 325, but it won't trade there. That's the key. The bid will go down to 325. The market is looking for traders. Is there any business down at 325? Does anybody want to sell it at the market and get filled down at 3.25? And if so, how many buyers are down there? I'll move the dome out of the screen now. So in that case, you'll have to be looking at, or you can just trust me, but I've done this in real time in the room, and people were able to see it, so they know what I'm talking about. So you have the market actually drop down to 3.25, at least on the dome, looking for business, and nobody wants to sell in this case, and this is exactly what happened here. Nobody wanted to sell 1403.25. Why? I don't know. I'll give you an example. I guess because the market was going straight up, and there were some other sellers up here, and they weren't driving it down. So when it finally got down here to 0325, people thought, I don't really think that's a good idea. It's going straight up, and not going to do it. So that's your failed auction, and the failed part is that the market actually got to 325 looking for business, and nobody traded down there. But because it's at 325 bid, that means it must be 350 offer. And when it was quarter bid at halves, 98 people said, yeah, hell yeah, I'm buying halves. This thing's going straight up. And only 98 got filled, but 98 lucky guys got filled and it went up. So again, quarter bid, no business, but in that instant it's half offer and somebody bought it and drove it higher. That could have happened in a fraction of a second. I've seen it happen where this situation will happen for 2, 3, 4 seconds, which is a very long period of time and very rare. It's usually in a fraction of a second. But I've seen it last longer than that. And in that fraction of a second, somebody bought the offer and it went up. So that's a pretty detailed, I think I actually used a little more of an example there than I usually do in the room because I have more time today. So I hope that Perry explained it for